investment appraisals. If you look at the purpose of management accounting, we know that it's planning, decision making, and control. And the purpose of this part or the subject is to help management in making decisions regarding to investments. When we started management accounting, so we looked at investment center. Some managers are responsible for investment center, and the responsibility is to ensure that investment is successful and it achieves its objective, which is set at the start. And those objectives were set with the help of investment appraisal exercise. When we started, we actually did some number crunching, and we decided that this is what we can achieve. This is our achievable target. So then investment appraisal manager or investment manager would be responsible to achieve those targets, and accordingly, obviously, their performance evaluation would be on that base. So that's managerial perspective on investment appraisal. When we do any investment, we want to start a new factory, we want to start a new product, and we want to launch a new program. All of these investment appraisals are carried out financially. So just like budgets are numerical, financial investment exercises are all numerical as well. They are in financial terms. You will get an idea before starting. You can ask your accountants to give you, if we do this investment, if that is going to make a profit or a loss. Generally, these techniques which we have in investment appraisal, they give you black and white result. So they say, okay, if this is the result is like this, we accept the project. If the result is the other way, we would reject the project. However, in reality, the things are not black and white. Sometimes companies start a project which is not supported by the investment appraisal techniques, and the other way around, because this is the manager's decision making and the gut feeling as well. And sometimes our strategy compels us to take short and medium term losses because it aligns with our strategy. It may seem like that your investment in this module is 14,000, but actually if you think a little deeper, you would know that it's actually more than that. Yes, because you are paying accommodation expenses and then your living expenditures. These are quite obvious ones. So you should add that to this investment as well. And the other one, which is not so obvious, is because you're here, you're doing this course, you can't do a full-time job. So you're losing money elsewhere as well. So on average, starting salary, even if you do it 25K, you're losing 25K per annum because you're doing this course. So you should add that into this course cost as well. That does take you well above 50K. That's 1 year. That's very typical. Anybody who comes to education, that is their cost, actual cost. What is the benefit? If you sit down, do a little bit of research, you can actually work out with a margin of error that what is the benefit you're going to get out of this course. So the data is available on the employees who have a master's degree and how much on average they earn, and then only those who are graduates. So there's a difference, maybe 5K, 10K annual, but there is a difference in that. So that is your marginal incremental gain per annum from this course. It would also open up some of the advantages of career progress. If you're only a graduate, you may not be able to become a senior executive ever. So, I teach some managers who want to become an executive. So they're doing this course because of that. So you can actually work out that what are the advantages in career progression because of this course. And we can actually compare extra incremental income you will earn because of this course and otherwise. And then you can compare it with your investment, and you can work out if this course is beneficial from a financial perspective. Obviously, there are other reasons people would like to do masters, self-esteem, for example. But financially it is doable, that, and actually it is beneficial. It would get you extra million over the duration of your career. Every big investment is a strategic decision. It's not a short-term or tactical decision. The impact of that investment is going to last for next 10 or 15 years. When you are at that level of management in board of directors and you're responsible to grow the business or achieve the main objective of the business, which is shareholders' wealth, increase in shareholders' wealth. So there's agency theory that all these big companies, owners are on one side and the managers on the other side. And basically shareholders trust managers to run the business on their behalf. So managers are agent, and they are responsible to do all what they can to increase the wealth of shareholders. So that is the primary function of the companies working in capitalistic economies, or all of the private corporations. And if managers, they perform well, they make profits from their investments, then shareholders are going to invest more, and they would expect to get more return. So when you ask shareholders to buy shares in your company, you actually promise them that you will earn some money for them. That is possible by initiating new projects, launching new products, doing research into things which don't exist, and then hoping to make money out of that. So these are the real assets which management is going to invest in, and then hope that those investments are going to bring in those benefits. So investment appraisal is basically analysis, financial analysis of those proposals which management hopes to launch in future or to carry out, and see if we are going to make a profit or a loss, or should we go ahead with a certain investment proposal or not. And there are many techniques. At level 3 undergrad accountants, I teach financial management, and we teach them like 10 different techniques, very high level, sophisticated techniques on how to assess the different investment appraisals. At this module, we're only doing the one main one, which is the basic, or you can call it mother of all techniques as well, which is net present value. So we will learn net present value in good detail, and we will discuss how the decision making works out for net present values. NPV gives you black and white. Okay, do the investment or don't do the investment. But then there are other factors which needs to be taken into account. We will discuss those as well. However, in reality, net present value is just a start. Although it does give you clear answer, but it's still just the start. And we carry out a lot more exercises after doing NPV. What type of decisions we could do? Build a new factory or extend one. So the option could be, for example, Elon Musk is building a new factory in Germany. The option was to carry out in China and transport all of the cars from China to UK or Europe, or from America to Europe. So these were the options. Then obviously the option was to build a factory in Europe. So this decision was made actually on the basis of numbers, that which option is better. And obviously the option of building the factory locally in Europe was financially viable or more beneficial. That's why they decided to build the factory there. So all these kind of decisions are actually a product of investment appraisal. Should the empty piece of land be used for a multi-story car park, or build a shopping center? So that is another interesting decision-making exercise. Which product should be launched out of available options? Generally, if you are working in a big company, and those company launches so many products every year, and this is true for the gaming industry nowadays, especially softwares, gaming industries, medicines industry, for example. They're always launching more and more products every year. At the start of the process, which could be a budgeting process, each manager will present different ideas to the board of directors, or the people who are responsible for the budgets. And then those ideas would get approval depending on their viability or how they sound to the managers on the principles of investment appraisal. If a manager presents 3 different products, which one to launch, the starting point would be NPV appraisal, to be sure. Yeah. However, there are sometimes there are some qualitative aspects which are taken into account. But if a product does have a positive outcome as a result of NPV appraisal, the chances are it would get approval. Should a company invest in a new computer-controlled multi-use machines or continue maintaining the old machinery? It costs a lot of money to maintain machines. You have to keep an engineer on site. You have to keep replacing the parts. And one of the biggest disadvantage of having old machinery is the breakdown time. What could happen that you have like 200 laborers in your factory for the day and your machines breaks down. Now you're paying them because they are here, but you can't produce anything. So that is actually one of the biggest disadvantage of having the old machinery. Another very good investment appraisal which is happening right now is self-driving cars. And companies are investing billions of pounds on self-driving cars. The concept would be that in the next 10 years, these cars would be so common that none of us would like to have our own car. We would actually use these self-driving cars, which would cost maybe half or maybe 30% of the cost which you pay now. So it would be so cheap that we would rather go on the public transport, and this is going to happen in the next 10 years. The problem with all of the investment is that you invest money now and then you hope that you would actually get some money back. And if you are going to get something in future, it would have more risks. It is certain that how much you are going to invest now, and it's not certain how much you're going to get in future. Most of these investments are such that if they fail, the company could fail. Management accountants are quite expert in getting these guesses, yes. So a lot of marketing research happens before we start these exercises.